Hey there, guys. Welcome back. And this is going to be a short one. And the reason why it's going to be a short one is because we're going to go into a lot of financing options coming up that's going to be divided into a couple of parts. And I didn't want to kind of get into this and then get into those other things, which I think are going to be pretty critical to how you proceed once you decide to invest in real estate. But, we kind of made this joke about, you Lay's potato chips, I bet you can't eat just one. And a lot of that has to do with the fact is once you get into real estate and once you find this to be successful, you're going to find reasons to buy more real estate investments. And we're going to explain why also that's a good idea. Now, one thing, and I know there's a kind of a push and shove on this idea, but we're always talking about mitigating risk. And one way that you can mitigate risk is investing in multiple properties. Now, got to have the financial wherewithal. You got to have the reserves. You don't want to, risk losing everything. That's just not the thing to do. But, once you're successful, once the cash flow's coming in, once the appreciation is there, then multiple properties are going to really help you out. Very simply, is this. If you have one property and it's vacant, it's 100% vacancy rate. If you have 5 and one is vacant, it's a 20% vacancy rate, and you still have money coming in from those other 4 investments. This is one simple way to look at it. Another way to look at it is not putting all your eggs in one basket, as you see in the picture. I have seen some people do some pretty crazy things. You go into a single neighborhood, you want to buy 3 properties, and you buy them all together. Or you don't know that maybe even within that neighborhood that there's 20 homes on the block and 10 of them are investment properties. So you don't want that. And so one of the things that you can do is kind of go, okay, I'm in this one particular neighborhood with this one particular type of house. Then, maybe I go into some other neighborhood or some other state or city or whatever it happens to be. But be careful. Now, I do have people that invest multiples in one neighborhood. But when I'm talking about multiples, I'm talking about 2 or 3, I'm not talking about 10. That's not the way I think this should work. Mitigating risk is to kind of go into different areas, different kinds of properties that you can invest in. And again, remember we talked about that 20% vacancy rate with 5. So that one red one there is the vacancy. That's glaring. So, what really good property managers do is if you have 5 properties, they don't all renew on the same date. That's going to be one way you can mitigate risk. And so one does come up and, even if it's a 10-day or 15-day vacancy, it's no big deal. Worst case scenario, you still have enough money to cover everything or your losses are very minor. And so that's one of, I think, the very strong reasons why you need to think about investing in multiple properties. Again, my advice to all beginning investors is don't get crazy. Buy the first one. See how this works. See if you're happy with being a landlord, understanding everything that happens after the sale, working with the property management, understanding the system. That's still a good thing. But once you get a taste for this, once it works, then it's a really good thing to invest in. So, I just read something today that if you take the basic American public, 30% of their wealth is in housing. Now, it could be that's their personal home. But again, going back to the 1%, they own a lot of real estate. And that's why they are rich. One of the reasons they are is because real estate is one of the safer investments you can make and one that gives you a good yield. And if the idea is to build a 7-figure net worth off real estate, and I think that's a great goal. And here's the interesting thing. I grew up at a time where when I was young, thinking that I had $1 million was like, oh my gosh, I'm on easy street. Now it's $2.5 million is where wealth really begins. But let's talk about what we talked about earlier about diversifying, some of your investments. But if you can have 5 houses that over 7 to 10 years that you can sell and net $1 million, well, you're well on your way. And you've made money during that time. So, that is the thing about, building up numbers is to give you that net worth that gets you into that area. Trust me, I've got some people with 20, 30, 40 properties, all getting close to being paid for with incredible wealth. I'm not saying that's for you, but I understand there's some people that are investing quite a bit. I've got one person right now, we're finishing up on his 20th home. And that's his Fannie Mae limit, which we're going to get into in a minute. And so, the thing is if we take, something that 20 homes that you can sell and net $250,000 a home, 7 or 10 years down the road, and with 20, do the math, you can see what it works out to be. But again, there's responsibility and risk management in real estate investing. Anybody that pushes you to keep buying and buying and buying, run away. I mean, that is not responsible on my part, on any investment person, any realtor's part. They should know where you are. This should be a very frank, transparent conversation about what the risks are. In other words, hey, this is working out really well, but maybe instead of buying 2 or 3, let's wait here and let's buy 1. I have some people right now that are 25, 30, 35 years old. They have a lot of time to build this up. I have some people that are in their 50s and 60s with a lot of money. And so they're maybe in a little bit more of a hurry. But these are the things that we analyze. Your income, your age, the requirements you have on expenses. All of these things go into play when we talk about should we go into multiple properties. So something that's extremely important, but is that you see when you have this nest egg building up, that green is money. And that's extremely important to you and important to your family. I cannot emphasize that enough. Partnering with a real estate investment specialist and a financial advisor for success, this is a real key factor. So I work with a CPA all the time. My wife and I mean, buying, holding, selling, doesn't matter what it is. I have a financial advisor because we invest, I said before, we invest in different things. We have a lot in real estate. She used to be a real estate attorney at one time. And so she understands what we're doing. And so this becomes a part of our financial success. So again, if you want to be really good at this, if you want to get that 7-figure net worth or more, go with professional people in every step of the way. So that's the thing about what potato chips are like in terms of real estate. Again, I think if you act responsibly, if you're at a particular age, you can say, well, maybe I'll get 1 every 2 years, and in 10 years I'll have 5. These are the things that an investment specialist is going to go with you on and talk to you about. They want to make sure that you're safe, because if you're not going to buy another one again. And we certainly want you to buy more, but buy more responsibly with the lowest amount of risk possible. So that being said, we're going to go into a couple of more modules, a couple of more videos here about some of the most important aspects of financing your real estate investment for the kinds of investments that you're making. We're going to go into some detail on this, so stay tuned. I think this is going to be a very important section for you to listen to.